This is our fourth program, and we are in Chapter 2. I want to pick up at annuities, page 2-11. And on your handout that you have that you should be filling in notes, and we've filled in half of them, I want you to pick up here at gross income, and we're going to start talking about the annuities and the general rule. So just kind of wanted to update you where we were. And so let's continue. Basically, annuities are investments, and these are investments. These are investments that has payouts and periodic payments for the remainder of a taxpayer life. So what happens is that a lot of times when people retire, they take their whole retirement account and they invest in an annuity that's going to make periodic payments for them. To them over the remainder of their life. And that those periodic payments amounts are based on the purchase price and the life expectancy. So basically that's what an annuity is. Some people just initially purchase into an annuity, throughout their working time or just over a period of time, or some of them take their retirement and they invest it or put it into an annuity in order for it to pay out its life. Pay out periodic payments for the remainder of its life. Okay, so there's a general rule that we're going to look at first, and basically the general rule is as we put in our portion to the annuity, as over the years the annuity will grow, it'll earn money, and so that helps create what we call a taxable portion of the annuity and a tax-free portion of the annuity. The amount of the annuity that we put in is considered, it's going to be tax-free, but the earnings on it is taxable. Okay, and on page 2-11, we have what they call an exclusion ratio. So I can determine how much of the monthly or the annual annuity payment that I receive, how much of it is going to be taxable to me. And so if you look on page 2-11, under the general rule, they have, if you take the investment in the contract and you're going to divide it by the annual payment, meaning what am I going to get within a year, my annual payment, times the life expectancy, which you're going to get that off of an IRS chart that they give you, times the amount received. And when you go through that calculation, that's going to represent the amount that is excluded, from your income. And then the difference is going to be the taxable portion. So if we look at the bottom of page 2-11, let's look at the example and then we'll do one together. Alan purchases an annuity for $100,000, which pays him $12,000 per year for life. So the $12,000 represents his annual payment. His investment in the contract is $100,000. At the date of the purchase, his life expectancy is 10 years. Okay, and so on page 2-12, page 2-12 at the top, they show you the calculation. They show you the $100,000 divided by the $12,000 times the 10 years, and then you're going to multiply it by what he received this year. In this case, it was the full amount, the $12,000, and so that means that $10,000 of it is excluded. So on his tax return, $2,000 would be taxable, and then $10,000 would not be. So given that calculation, that's how you come up with the excluded amount. So let's do one together. If we look on page 2-13 under the self-study problem 2.5, let's look at that one and do it together. We have part A, we have Phil. Okay, Phil is retired as of January 2008 at the age of 63. His pension is $1,500 per month from a qualified retirement plan, and he contributed $42,500. So we're doing the self-study 2.5 on page 213, and he has 21 years of life expectancy. So we want to, the calculation is his investment was $42,500, and it's going to be divided by his annual amount. Okay, he gets $1,500 a month. So basically, I'm going to take the $1,500 times 12, and that's going to represent the annual amount. That'll represent the annual amount. Let me blow that up some for you. And then we multiply that times his life expectancy, which is 21 years. Okay, and then we're going to multiply that times what he actually received this year, and they tell us that he received 11 payments of $16,500. Okay, so the annual payments that he's going to get out of the plan is the $1,500 times the 12. He's going to get $18,000 a year out of the plan, and we want to multiply that times 21 years, and that gives us a bottom number basically of 378. Okay, so if I take my $42,500 and I divide it by 378, and then I multiply it times what he actually received, and then I get $1,855, and that represents the amount that's going to be excluded, meaning the amount he does not have to include in his income. He does not have to include in his income. The question is to calculate his taxable portion. So basically, if he receives $16,000 and he gets to exclude $1,855, that means he's going to have to include, or the portion that is taxable is going to be $14,645. So that represents the taxable portion of the amount that he received, the taxable portion of the amount that he received. And that is our general rule. That's the general rule in which we figure out how our taxable portion of an annuity. That's the general rule. Okay. This exclusion ratio, which basically, if we go back here, this right here represents what we call our exclusion ratio. Okay, it's the amount that he contributed divided by the annual amount times 21 years. So if we go through that, we'll get an exclusion ratio. Let me get the actual ratio. Divided by the 378. We'll get an exclusion ratio of like 11.243%. So this exclusion ratio is the amount that he would use every year times what he actually received. Is the amount that he would exclude every year based on the amount that he received. Okay, so it depends on how we use this exclusion ratio based on when the annuity began. For annuities that began before 1987, this exclusion ratio is used for the life of the individual. So if for some reason the individual dies before they recover all of their portion, then the unrecovered amount is going to be lost. It's going to be lost. Okay? If the annuity starts after 1986, then the maximum amount that's going to be excluded is going to be limited to their investment. So basically, once this individual has excluded $42,500, which is his investment, then any other payments that he received after that, all that's going to be taxable. So if the annuity starts after 1986, then the maximum amount that he can exclude is going to be limited to his investment. And then after the investment has been recovered, meaning he's excluded the $42,500, then everything else is taxable. If he dies prior to recovering his investment, meaning being able to exclude up to the $42,500, then the unrecovered amount is going to be able to be taken on his tax return as a loss. So that's the difference between if this is an annuity that started before 1987. If that's the case, then he gets to use that 11% throughout his life. So even if it recovers or he excludes $42,500, he gets to continue to use that exclusion amount, even though now he's recovering more than what he invested. If it's after 1986, then once he recovers his investment, he is going to have to record any payments as taxable. Okay. So there's another. That was the general rule and the general calculation of how we come up with this exclusion ratio. We have what we call the simplified method. If you look on page 2-12, and this was used for annuity payments starting after November 18th of 1986. Okay, and there is a worksheet attributable to that in order to calculate the taxable portion of their annuity. There's a worksheet in which they have in your book. So if you look on page 2-12, you see the simplified worksheet here. And I kind of blew one up as well so that you could see it. So here's our simplified worksheet. And so what we do is we also use the amount that you actually receive, because that's the amount that we're looking at, and we're trying to determine how much of that amount is taxable. And then we look at the investment or the cost to the annuity, and we look at your age at the start of the annuity. Okay, so looking at this sheet, let's go ahead and we want to work through the self-study problem. 2.5 on page 213, and this is part B. We did part A using the general method, and so now we want to look at B using the worksheet. Okay, so it's the same problems. Okay, we have Phil who retired on January 2008 at the age of 63. So when he retired, he was between 61 and 65. So we're going to be using that number there. Okay, so let's get started. It says, enter the total amount that he received this year. It tells us that he received $16,500 this year. That's how much he received. Enter the cost in the plan at the annuity start date. Enter the cost of the plan at the annuity start date. And he put in, or his investment was at $42,500. And then it tells us to enter the amount here based on his age at the start date, which was $260. Okay. Then it tells us to divide line 2 by 3. Okay, so we want to divide line 2 by 3. So 42,500 divided by 260 gets us 163. Okay, and then on number 5, number 4, divide line 2 by 3, we did that. Okay, number 5, multiply line 4 by the number of monthly payments this year that he received. And remember, they said he received 11 monthly payments. So he received 11 monthly payments, and so that gets me $1,793. Number 6, enter the amount, if any, recovered tax-free in prior years. This is his first year, so he doesn't have any prior year amounts that he received or reported as tax-free. Okay, so that's be any. So then that brings us down to still $1,793. That minus, we didn't have any prior amounts. And then on 8, it says enter the smaller of line 5 or line 7. Okay, and they are the same amount. Okay, and then so that represents the amount that he gets to exclude. It says, so the taxable amount this year is going to be, we're going to subtract line 8 from 1. So we're going to take his $16,500 minus the amount he gets to exclude. And so the amount that's going to be taxable to him is going to be $14,707. That's going to represent the amount that is going to be taxable to him. Okay, so that is how you do the simplified method. It's a little worksheet that they give us. You kind of go read through line by line, and basically you're coming up with the taxable portion that is going to be included in the income. And then we had first figured out the excludable amount. Okay, so for annuity starting after November 18th, 1996, we will be using the simplified method, not the general formula that we use. Okay. Employee annuitants, these are payments for qualified retirement plans where contributions by our employer. Those are not going to be taxable to the taxpayer in the current year, so they're not taxable to them, the taxpayer, if your employer is making those contributions. Okay, that's our annuities and how we determine what's taxable and what's not. Next, we want to look at life insurance. Generally, life insurance, if paid due to death, you know, if I receive life insurance due to I was the beneficiary on someone's policy, that is not going to be taxable to me. There's a possibility to get early payouts of life insurance, basically accelerated death benefits, and those still be excludable. They'll still be excludable. On page 214, they explain what is considered terminally ill, chronically ill, and therefore us to have the ability to receive those benefits and use them for health purposes, and that they are still not taxable to us. They're still not taxable to us. On page 214, they talk about early payouts due to this. Early payouts, which are called accelerated death benefits, are excluded from gross income for certain terminally or chronically ill taxpayers. Okay, so therefore that taxpayer, that ill taxpayer, may either collect an early payout from the insurance company or sell or assign the policy to a provider, settlement provider, in order to get that money, and then it's still not taxable. A terminally ill individual is someone who a doctor certifies that they have, they can reasonably expect that they have 24 months to live. So if that's the case, and they either cash out their policy and use it themselves, or if they sell it and get the proceeds from it, then it's not going to be taxable. A chronically ill individual must be certified by a medical doctor as unable to perform daily activities without assistance. So they have to be certified that they can't do that. Chronically ill taxpayers may only exclude the gain on accelerated death benefits to the extent that those proceeds are going to be used for their long-term care. So they can basically, if I'm chronically ill, I can't do daily things by myself. Therefore, I can use the benefits, get accelerated benefits from life insurance for my long-term care, and it's going to be excluded from income. It's going to be excluded from income. So those are benefits that people can use in dire situations where someone's terminally ill or chronically ill. Okay. Now, if a policy is transferred for value, maybe it's transferred to settle a debt, or whatever the case may be, is transferred for value, then all or a portion of those benefits, therefore, could be taxable. Okay. And so to explain these, let's look at the examples that appear on the bottom of page 214. The examples that appear on the bottom of page 214. We have Howard dies on January the 15th and leaves Wanda, his wife, a $50,000 insurance policy, the proceeds of which she elects to receive $10,000 per year plus interest for 5 years. Okay, so in this situation, it's just your basic death and the wife or Wanda receiving the insurance. The difference is that she elected to receive it over time. So the interest portion that she receives on those life insurance policies is going to be taxable. The principal is not. So the example tells us that it was a $50,000 policy. She elects to receive a $10,000 per year plus interest for 5 years. In the current year, Wanda received $12,200. So $10,000 of it is the actual proceeds from the policy. $2,200 of it is interest. The $2,200 of the interest would be taxable. Next example, David owns a life insurance policy at the time he is diagnosed with a terminal illness. Over the years, he has paid a total of $10,000 in premiums on the policies. Okay, after his diagnosis, he sells the policies. Okay, for $100,000. David is not going to be required to include that $90,000 gain because he only paid $10,000. He received $100,000 for it, so there's a $90,000 gain, and so that is not going to be included in his gross income. Okay, next we have Amy, who transfers to Bill an insurance policy with a face value of $40,000 and a cash surrender value of $10,000 for the cancellation of a debt owed to Bill. So Amy has a policy. She transfers to Bill. Okay, and so therefore now Bill becomes the beneficiary on her policy. It had a face value of $40,000 and a cash surrender value of $10,000, and that $10,000 was the cancellation of a debt. So apparently she had a debt of $10,000 that she wanted to get rid of, and so she did the policy in exchange for that. Now Bill now has the policy. Bill continues to make the payments, and then after 2 years, Bill has paid $2,000 in premiums, and Amy dies, and Bill collects the $40,000. So basically, Amy transferred it to Bill for a $10,000 consideration. Bill continues to make payments on the policy, an additional $2,000. So basically, he has in it a $12,000. Amy dies. Bill receives the $40,000. Since the transfer was for valuable consideration, then Bill must include $28,000 of taxable income into his income, which is the $40,000 minus the $12,000 that he had into it. So the $12,000 is not going to be taxable to him, but the $28,000 would be. Okay, so that is your life insurance. So generally, life insurance is not taxable. There's a possibility that accelerated death benefits from life insurance, you can get early payouts and they won't be taxable. But normally if the policy is transferred for value, then there's a portion that will be taxable. Okay, we pick up on page 215, gifts and inheritances. Gifts and inheritances are excluded from income. And but if you take an inheritance, obviously invested, the income that's earned on that inheritance is going to be taxable. Gifts are going to be excluded from income, except if there's a business gift. If it's a business gift, then they're going to be taxable if the recipient rendered some type of service. So let's look at these. They have two examples on page 215 regarding gifts and inheritance. One example, in January of the current year, Richard inherits shares of Birch Corporation stock worth $22,000. So he inherited the stock for $22,000. After receiving the stock, he is paid $1,300 in dividends during the current year. Okay, his gross income from the inheritance for the current year is $1,300. The $22,000 fair market value of the stock is going to be excluded from income, but the $1,300 that he earned on the stock would be included in his income. Let's look at the self-study problem, 2.7. Don is an attorney who supplied a list of potential clients to a new attorney. Lori. This list added to the success of Lori's practice. Lori was very pleased and decided to do something for Don. In the current year, Lori gives Don a new car worth $40,000. This was a gift. Don didn't ask for it. Don gave her a list of potential clients with no expectation of any payment for that. He just gave it to her. It turned out great. She was excited, so she turned around and gave him a new car. Lori was not obligated to give the gift to Don, and she did not expect Don to perform future services for the gift. How much income, if any, should Don report? Don is going to have to report the $40,000, the value of that car, as income, even though none of this was expected, none of it was required. There's a rule that the courts deem with these business gifts that even though there's no obligation, that they're going to be seen as taxable. If you look in on page 215, in the paragraph, the under gifts and inheritance, that last, it tells us that the courts are likely to rule that gifts in a business setting are taxable, even if there's no obligation to make the payment. Also, if the recipient renders services for the gift, it will be presumed that it's income. So with business gifts, they're just going to deem that they are taxable. So be careful with the business gifts. Okay. Next, we want to look at scholarships. Scholarships on page 215. Scholarships, there's a portion of scholarships that are excluded, and those are fees, books, tuition, course supplies, and equipment. You do not have to include those in your income, but if a scholarship includes room and board portions of scholarships are included in income. And then if for some reason you're providing some kind of work or whatever the case may be, that's going to be included as well. If you're required to do like a work study, if you're required to do some work. Let's look at the example on page 215. In 2008, Diane receives a $5,000 scholarship to study accounting at Big State University. Diane's expenses for tuition and books amounted to $1,200 during the fall semester. Therefore, she would have a taxable income of the difference. She received $5,000 $1,200 was tuition and books, which is not going to be taxable to her, but the difference of $3,800 would be taxable to her. So that is, let's look at the top of page 216, a self-study problem. It tells us, indicate whether each item below is included or excluded from income for 2008. A $2,000 National Merit Scholarship for tuition is excluded because it's tuition. A basketball scholarship for room and board is going to be included. Payments under a work-study program are included. Salary for working at Beach Research Laboratory is included, is taxable. A stipend for graduate teaching assistant is included. And then payment received from an employer while on leave working on a research project, and that's going to be included. So all those is included. Just the tuition, fees, and books are going to be excluded. Okay. Next, we want to look at accident and health insurance. The payment of medical care or for premiums that are paid on your behalf are excluded. You do not have to include it in income. Let's look at the quick example that's on page 216. Bob is a married taxpayer. His employer pays $250 per month of premium on a policy covering Bob and his family. Jean, Bob's wife, is sick during the year, and her medical bills amount to $6,500. So they make $250 monthly payments for the premium, plus she had $6,500 that the insurance company paid $6,000 of. Bob and Jean may exclude from income the $250 monthly payments. They don't have to pay those. And $6,000 that was paid by the insurance company, that's also excluded. The $500 that the insurance didn't cover could also be deductible on a Schedule A, and we'll look at Schedule A in a later chapter. Let's look at the self-study. Problem 2.9. We have Marjorie, who's a single taxpayer, is an employee of Big State. Big State Corporation pays premiums of $1,000 on her health insurance for the current year. Also during the year, Marjorie has an operation for which the insurance company pays $5,000 to her hospital and doctor. Of those amounts, how much should be included in her gross income? And none of it. She does not have to include any of it in her gross income. Okay, let's keep going. Next we have meals and lodging. You know, do I have to include meals and lodging? They're generally going to be excluded if the meals are provided by the employer on the premises for their benefit. So, for instance, if you get a very short lunch break, which sometimes, like at fast food restaurants, McDonald's employees may only get a 20-minute lunch break. And so to keep them there, they are able to eat for free. Those meals are not going to be included in their income because it's on the premises and it's for the employer's benefit so that they won't have to go away and have lunch. Lodging provided by our employer on premises and required for lodging to be excluded from income. It has to be on the premises and required by the employer. An example is if I am a handyman, and a maintenance individual, and at an apartment complex, and they provide me with an apartment on the premises so that I am close to the apartment complex if something goes wrong in the middle of the night or whatever the case may be. So if I am required, I have to be required to stay there in order for me not to include that in my income. If they give me the option, if they say, well, you don't have to stay here, but it's just, it's for your benefit because you won't have to drive in if something happens. So if they give me the option and I choose to stay there, then the income from, if I do it for free, and I don't have to pay rent, then the income, that rent would be considered income and included in my income. So the key with that is that it has to be on the premises and required. So if they give me the option, then therefore, that's going to be income to me. Let's look at the self-study, 210. Indicate what would be included versus excluded. A waiter is required to eat lunch furnished by his employer on the premises during a busy lunch hour, and that would be excluded. Okay? A police officer receives a cash allowance to pay for meals while on duty. That is not provided on the premises. So therefore, that allowance that the police officer receives would be included in his income. A worker receives lodging at a remote construction site in Alaska. Okay, because it's remote, he doesn't have any other options, so it's going to be excluded from his income. A taxpayer manages a motel, and although the owner does not require it, she lives at the motel rent-free. Because the manager does not require it, it's going to be included in her income. A bank teller is furnished meals on the premises to limit the time she is away during busy hours. That's excluded. And then a hospital provides a free lunchroom for its staff. The staff is not required to eat there, but the hospital administration wants to encourage the employees to be on the premises for emergencies, and that is excluded. Now, meals, they don't have to be required for them to be excluded. So even though they're not required to eat in the lunchroom, it's an option, it's going to be excluded. Okay. Next, we want to look at municipal bond interest. Municipal bond interest, basically excluded on state and local government obligations, but it doesn't apply to bonds that are used to directly or indirectly buy a business. So if they're business or corporate bonds, then they're not going to be excluded. But muni bond interest is exempt from income. Muni bond interest is exempt from income. Okay. Next, we want to spend some time looking at Social Security benefits. You hear a lot of people talk about whether Social Security benefits are taxable or not. It depends. And there's a calculation you have to go through. We're going to look at a handout, and we're going to go through the calculation, and we're going to look at an alternative. The maximum amount that could be included in income is 85% of your Social Security benefits. So you may have to include up to 85%, okay? And it's based on what we call modified AGI, and we'll look at what that is. And it's based on that, and then they have upper and lower limit, and then we have this fairly lengthy calculation that we look at that have to do with whether our Social Security benefits are taxable or not. And there's some base amounts and things we want to look at. Okay, so let's start off by looking at our book on page 218 under the Social Security benefits. And they talk about what this modified AGI is, because that's what we're going to be looking at, and we're going to be comparing that to some base amounts. Okay, we're going to be comparing that to some base amounts. Okay, in that first paragraph, they tell you that to determine what is taxable is going to be based on MAG, or modified AGI. Okay, MAG is the taxpayer's AGI. So to get the modified adjusted gross income, we start off with the taxpayer's adjusted gross income. So it's the taxpayer's adjusted gross income, not considering the Social Security benefits, plus any tax-free interest income. Okay, so we're going to add back that tax-free that we didn't have to include. Then they tell us, and then on occasion, taxpayer will also have to add back certain unusual items such as foreign earned income exclusion, employer-provided adoption benefits, or interest on education loans. So just keep in mind, the MAG, it starts with AGI, and the basics of it is you're going to add back your tax-exempt interest. But then if you've taken some of those other deductions I just mentioned, you could very well have to add that back as well. Okay, and so then the question is, either 50% of your Social Security benefits are going to be included in income, basically, or up to 85% is going to be included in income. Okay, in our book, they give us a worksheet. They give us a worksheet that I want to look at. And there's one in the publication 17 that is slightly different than this. Different tax books use different ways of showing it. The calculations are always going to be the same. You just may get to it a little differently. And so what I want to do is I want to go through a self-study using this worksheet. And the worksheet, as all the other worksheets we've used thus far, you have to really read line by line and picking up the necessary information. And then I'm going to show you basically the calculation without the worksheet. How do we come up with it? I also sent that to you in the mail, so when I'm going over it, you don't have to write it down quickly. All you have to do is just kind of follow the calculations as I go over them. So I want to use the worksheet, and we want to do page 2-20, and we want to do self-study 2-12. So that's the one we want to do. We want to do self-study 2.12, and this is on page 220. Okay, 2008. We have Kim and Edward, and they're married, and they file a joint return. They have Social Security benefits of $13,000, and their adjusted gross income is $20,000. So remember, to get the modified adjusted gross, we start with adjusted gross, not including Social Security income. And then they receive $30,000 in tax-free muni bonds. So there's your tax-exempt interest that you're going to add back. Okay, so let's just kind of begin to go through the calculations. They asked us to enter the total amount of Social Security income. That is $13,000. Okay, and then they asked us to enter 1/2 of that amount, which is $6,500. Okay, and then enter the total of taxable income from 1040, except for Social Security, and basically that's your AGI, and we said that was $20,000. And then for 4, enter the amount of tax exempt interest, and that was $30,000. And number 5, they want us to add lines 2, 3, and 4. So we want to add up those, and we get $56,500. Okay. Line 6, enter all adjustments to AGI except for student loans, and basically those are those other adjustments. Okay, so if I ended up with some of those other adjustments, which we didn't have any of those. Okay, and then line 7 tells us to subtract line 6 from line 5. If 0 or less, stop here, and then no Social Security benefits are taxable. That's not the case. Okay, so basically any adjustments to AGI here except for, and they've told you which ones not to include, and then we would put that number there. And for some reason, if we made this subtraction and it was less, then none of our Social Security benefits would be taxable. But we have a number there, so that lets us know that some of our Social Security benefits are going to be taxable. And so line 8, it tells us to enter $25,000 or $32,000 for married, filing jointly, and we are married, filing jointly. $25,000 would be for single, head of household, and all those other filing statuses. Or 0 if you're married, filing separately, but we fit the married, filing jointly one. $32,000. And so number 9 says subtract line 8 from line 7. So I'm going to take $56,500 minus $32,000, and I get $24,500. It says if line 9 is 0 or less, stop here, none of our benefits are taxable. We still have a number, so therefore our benefits, some of our benefits are going to be taxable. Line 10, enter $9,000 or $12,000 for married, filing jointly, and that's us, $12,000 for married, filing jointly. Line 11, subtract line 10 from line 9. Okay, so subtract $24,500 minus $12,000, and that gets me $12,500. Line 12, enter the smaller of line 9 or 10, so $12,000 is smaller. 13, enter 1/2 of line 12, which is $6,000. 14, enter the smaller of line 2, which is half, all the way up here, half of my benefits are line, what did it say? Enter the smaller of line 2 or line 13, or the $6,000. The $6,000 is smaller. 15, multiply line 11 by 85%, the $12,500 times 85%, and you get $10,625. And then 16 says add lines 14 and 15, so I get $16,625. Line 17 says to multiply line 1 by 85%. Basically, I'm going to multiply my Social Security benefits by 85%, and I get $11,050. And then on line 18, it says your taxable benefits are going to be the smaller of line 16 or 17. And so the smaller amount is 17. So 11,050. 11,050 ends up being the smaller of line 16 or 17, which this represents 85% of my Social Security benefits. So in this example, we ended up hitting the maximum amount. We ended up hitting the maximum amount of 85% of the benefits. So basically, that is a worksheet that you go through. Now, the problem that I have with the worksheet, and it may be okay, it may not bother you, but the problem I have with the worksheet is that you go through the calculations, but you really, you're reading, you're multiplying this, you're adding this line to this line, but you really don't get to understand or comprehend what's really happening in that worksheet. How do I get down to the 85% versus why wasn't 50% of mine taxable versus the 85%? And when you go through the worksheet, it's hard to see that. It's hard to tell. Okay? So I have another calculation that it doesn't involve a worksheet. It basically kind of gives you a little bit more of what's happening, so that you can see, it's still a lot of calculations, but I'm thinking it's going to give you a better understanding of what's going on. Okay? It's going to give you a better understanding of what's going on. And basically, this is the way it works. You're going to look at married, filing jointly, or single, head of household, or widower. Okay? And so you're going to follow either this side of what's happening or this side of what's happening, basically. Okay? And so the way it works is you look at your modified adjusted gross income, and you have a lower limit and you have a upper limit. Basically, if your modified AGI is below this lower limit, so if it's somewhere here, then none of your Social Security is going to be taxable. So if I'm married, filing jointly, and I have modified AGI of 30,000, none of my Social Security is taxable. If I am single, head of household, or a qualifying widower, and my modified AGI, let's say, is 20,000, then none of it's taxable. So in that case, we'll say none is taxable. So that's first of all. You couldn't really tell that by the worksheet. How does none of it become taxable? And it depends on that lower limit. Okay? So the lower limit is 32,000 for married, filing jointly. 44,000 is the upper limit. So basically, if my modified AGI falls between the two numbers, then I'm going to follow the A calculation. If my modified AGI falls is more than the upper limit, then I'm going to follow the B calculation. Okay, so basically, if my modified AGI falls in between this number, then my taxable portion of my Social Security is going to be the lesser of 50% of my Social Security or 50% of the excess of the modified AGI over 32,000. Okay, so let's say, for instance, that my modified income is 40,000, which falls in between. Okay, so in that case, then I'm going to use this calculator, assuming I'm married, filing jointly. I'm going to use this calculation, and let's say my Social Security benefits are 3,000. Okay, so half of 3,000 is 1,500. So that would be 1,500, or it's because it's going to be the lesser of the two. And I said it was 40,000, or 50% of the excess of the modified AGI over 32,000. So if my modified AGI is 40,000, that's 8,000 over the 32,000. 50% of that is 4,000. So in that case, 1,500, which is the lesser of those two, is going to be the amount of my taxable Social Security. To me, that makes more sense than going through the worksheet. The worksheet should yield the same answer. Okay? If for some reason my modified AGI is over the upper limit, then I would go through the bottom half of the calculation. And that's what our example was in the book. So let's use the example in the book to go over that one. Once again, the example in the book had us a $20,000 AGI, $30,000 of tax-exempt income, and then $13,000 of Social Security benefits. So I'll see, I have about 4 minutes left. I'm going to try to do that in that time. 85% of my Social Security benefits is $11,050. Okay, I know that. Okay, and so then the taxable portion is going to be the lower of this $11,050, or this here calculation right here. 85% of the excess amount over the limit. Okay, 85% of the excess amount of the limit is I had 50,000, 6,000 is the excess times 85%, and that gets me 5,100. Okay, so that represents that number, 5,100. And then the lesser of 50% of the Social Security benefits, 50% of my Social Security benefits is 6,500, because it was 13,000, or 6,000, whichever is the smaller. So that's the smaller. So basically, I add the 5,100 to the 6,000, and I get 11,100. So my Social Security benefits are going to be the lesser of either the 11,050 or the 11,100, and the smaller amount is 11,050, which is the same amount that was yielded on the worksheet. So went through that kind of quickly. Take your worksheet that I sent you and go through the calculations and do that self-study problem that's on page 220, and see that you get the same calculation with the worksheet. Okay, so that ends it for today. We still have a little bit left to cover in Chapter 2 before we move on to Chapter 3. But Social Security benefits could be taxed all the way up to 85%. So we want to stop there, and we will pick up here in our next session.